Hello and welcome to the third episode of Learn Along, where I go and research things that I come across during my stock speed runs that I wish I understood better, and I bring you along for the ride so that maybe we can both learn something. As for the background track for this video, what you are hearing is the tutorial theme from Cuphead. So, let's go ahead and look into the topic for this video, which is EBITDA. Now, unlike the last episode where I did GAAP, Generally Accepted Accounting Principles, I knew what that stood for before I looked into it. I have no idea what EBITDA means. I know it has something to do with earnings. Oh, earnings before interest, taxes, depreciation. Okay, interesting. This might be a short video because that seems fairly self-explanatory. I always go to Investopedia. Let's go somewhere else different this time. Let's go to the Corporate Finance Institute. Sounds very fancy. Apparently there's a whole kinds of Formula 2. So, stands for earnings before interest, taxes, depreciation, and amortization. Get out of here. I don't want your damn cookies. Formulation for calculating EBITDA. Net income plus interest, taxes, depreciation. I thought this was without. I'm sorry. Earnings before interest on taxes and all these things. Net income, Oh, I see. I'm sorry. Because net income inherently means minus all of these things. Therefore, EBITDA is net income plus all of these things. I see. That makes sense. Otherwise, can be stated as operating profit plus depreciation and amortization. Because I guess profit, you take interest and taxes into account when calculating profit, but not these two things. That makes sense because these are less transparent. These are less transparent costs. That would make more sense. And you know what? I want a definition of these things because interest is fairly obvious, right? Is excluded from EBITDA, and it depends on the financing structure of the company. So this is the interest that they pay. These are the taxes they pay. I want to know more about this depreciation and amortization. Pretty sure I'm saying that right. Amortization. I don't know. It's one of those. I want to know a little bit more about what these two entail. Depend on the historical investments the company has made and not on the current operating performance of the business. Companies invest in long-term fixed assets such as buildings or vehicles that lose value due to wear and tear. That's the depreciation part, I assume. The depreciation expense is based on a portion of the company's tangible fixed assets deteriorate. Is there more to this sentence? Why does it feel like this sentence just suddenly stops? Hold on, let me read this again. The depreciation expense is based on a portion of the company's tangible fixed assets deteriorating. Okay, no, yeah, that sentence makes a little bit more sense the second time around. It's just that it ended on a verb, even though it's a conjugated verb, which is kind of weird. English is weird. Amortization, however, is incurred if the asset is intangible, such as patents are amortized because they have... I see. So, amortization is kinda like depreciation, but it's spread... I mean, that's what amortization means, I'm pretty sure. That's what amortization means. Give me back to Google. Why can't I go back to Google? What is up with this page? Oh, I guess I could have just done it right here. I'm pretty sure that's what that means, is to spread out over an amount of time, which makes sense for things that are intangible. Because it's fairly easy to put a cost, or not a cost, a value on a building or vehicle. You know, something that's physical, tangible, at any single period of time. It's kind of hard to put it on a patent. So it makes sense that, cause like, here, I'm gonna bring up paint again. Because, like, depreciation, you know, your line might look like this, then it might drop a little bit, and a little bit more. Maybe it'll even go up a little bit. Maybe suddenly the town where your warehouse is becoming very ritzy, and, you know, hipsters want to move there or something. But then let's say, you know, all the hipsters die or something, I don't know, and suddenly the price drops. So yeah, a depreciation chart is a lot more rocky. Amortization is just going to be a line. You know, in fact, hold on, let me get a better line. Because I literally have a line tool here. There, that's your amortization. It is spread out over time. Evenly and perfectly. That makes sense. Depreciation and amortization are kind of the same things, but they are applied to different assets. Based on whether those assets are tangible and can be assigned any fair market value at any one given amount of time, or if they're intangible and they can't, and thus their value is spread out over time. That makes sense. Oh yeah, I was going to look up amortization. I'm pretty sure it's literally what that means. Meaning in Hindi. That's kind of a weird, random thing to get. Definition. The action or process of gradually writing off the initial cost of an asset. I mean, yeah, okay, that's literally how they're using it here. So that makes sense. And it kind of makes sense why why this is important. So when I initially Googled EBITDA, one of you may have noticed it on the starting page, but one of the things was, what is EBIT? How the fuck do you spell this again? And why is it important? Why is EBITDA so important? Why is it better to understand earnings in the sense of these calculations, but not understanding other calculations? Calculation and analysis is important for business owners for two main reasons. Provides a clear idea of the company's value, as opposed to you know, the amount of taxes they're gonna pay. May very well strongly depend on, for example, where they're based or where they're incorporated. You can make an argument that's a business decision, but also it's kind of irrelevant as to how well the business does. Interest, I'm not too sure about interest. Interest seems like something that you would want to know. Comes from the money it has borrowed to fund its business activities. I guess it kind of makes sense that you don't want to include this because you don't want to see companies borrow money so they can make money, right? And if they end up having to borrow a lot of money, even if you think they're going to make money in the future, they're probably going to be paying a lot of interest. But if they had to do that to get to profitability at some point, I can see why you don't want that counted against them necessarily. Let the earnings numbers speak for themselves. So that kind of makes sense. And then the depreciation and amortization. I guess that's assets. And assets don't usually get counted into earnings anyway. Not that I understand, at least. Oh, here's a section about why use it. Why use it as a proxy for cash flow. That makes sense. It can give in fact, you know what? I want to look at the quick definition of cash flow. It can give an analyst a quick estimate of the value of the company as well as a valuation range by multiplying it by a valuation multiple. Also makes sense. When a company is not making a profit, investors can turn to the EBITDA to evaluate a company. Also makes sense, again, with the example that I gave about a company who had to borrow a buttload of money to get started up and eventually get to profitability at some point. They may be paying a buttload of interest. And it may make sense to count that against them, but in other cases it might not. And you know, you don't want to You don't want to overfault those cases where it doesn't against those cases where it would by counting it always. Did that random string of words make any sense? I certainly hope so. Uses it because they're very good for comparing similar companies in the same industry. Also, again, makes sense. Compare performance against their competitors, makes sense. What about disadvantages? I want to see this part. Is not recognized by GAAP or IFRS. We learned what both of these were in the last episode. Some are skeptical, like Mr. Buffett, of using it because it presents the company as if it has never paid any interest or taxes, and it shows assets as having never lost their natural value over time. Yeah, so all of the stuff I said before about how it makes sense that these kinds of things aren't included in earnings numbers, you can also make an argument that it does make sense to include them, right? Because interest is a legitimate thing the company pays. And if, like for example, think of an example where, again, my startup example of a company that had to borrow a buttload of money to get started, right? Let's say they eventually get to profitability, okay? Well, if the interest they're paying isn't transparent in the EBITDA earnings that they are reporting, then how would it be transparent in, let's say, the unlikely scenario that they get to profitability, but they've taken so long by that point that the profit they are now making is less than the interest that they are paying on that initial startup money. And let's say they can never overtake that interest. What if their earnings start to plateau a little bit? That's something that I would want to know. What if their earnings start to what if they finally got to profitability, their earnings start to plateau, okay? And it eventually gets to the point where that plateaued earnings starts to be overtaken by the interest they're paying, okay? And, that's something that I would want to know. I know it's a kind of a what's the word I'm looking for? Contrived, unlikely scenario, but it's still, it's not impossible. And if a company was doing that, that's something that I would want to know. Taxes also, like I said before, it seems like where a company has a large impact on the amount of taxes they pay, and that technically doesn't have anything to do with how well the business is, but I don't think you can make the argument that it's not a business decision where to be, and thus how much taxes you're paying. So let's say take the example again. I'm going to clear this. I'm going to clear this, and I'm going to say let's take the example of the same kind of company, right? Let's say they have stagnant earnings, and let's say that they can increase these. Well, I don't know where I was going with this example. All right, screw it. But I think you kind of get the idea. Like, if a company is paying a buttload in taxes because they made the shit decision to incorporate in, Lord forgive me for uttering this word, but California, and they don't have the bearings, the wherewithal to move. That's a decision I feel like I would want to know as an investor, right? Because that state is going to bleed that company dry. Don't pretend like it won't. And then the depreciation and amortization. I mean, if your assets are losing value over time, and let's say your assets are where a lot of your income comes from, that's something I would want to know too. So yeah, there are arguments to made both sides about whether or not this accounting makes sense or not. And in fact, down here, I should have taken a look. They seem to have an example. Fast-growing manufacturing company. They present increasing sales and EBITDA year over year to expand rapidly. It acquired many fixed assets over time, and all are funded with debt. Although it may seem that the company has strong top-line growth, investors should look at other metrics as well, such as capital expenditures, cash flow, and net incomes. Very similar to some of the examples I just gave, so that makes a lot of sense. I don't know if I'm on the side of Mr. Buffett here. I feel like there's good arguments. Actually, I kind of think I am. I can see arguments as to why EBITDA exists and why it's calculated this way, but I kind of feel like it shouldn't be, because it doesn't necessarily give a fully accurate picture of where the company is at, and depending on the placement of the company and what their current status is, that can be extremely misleading. So you know what? I think I kind of agree with Warren Buffett here that I think these things should be taken into account and included when calculating earnings. I think that makes sense to me. But then again, I am someone who doesn't necessarily like my info dumbed down. I feel like the more information that I can get thrown at me, the better. Even if I don't know what to do with it, it's still good to have. So that's that for that. Oh yeah, I opened cash flow. Increase or decrease in the amount of money a business, institution, or individual has. Okay, that's that kind of makes sense. Maybe I'll save that for. I mean, I kind of figured I knew what cash flow was over time. But maybe I'll save that for another video, perhaps. Or I can just look at it here. No, I'm gonna save it. So I think we read a little about why it was important on that page. I want to see what this page has to say about why it is important. Stands for earnings before we know that. Business validations, how to calculate, margin. Ooh, wait, what's this talking about margin? Determines a percentage of calculated EBITDA against the overall revenue generated by the company. Goals to determine the amount of cash profit that a company makes in a year, which again, isn't really all that accurate. To be honest, I'm kind of with Warren Buffett on that. Coverage ratio. All right, wait. Let me read about margin. Oh, it's literally your earnings margin. Okay, it's your earnings against your revenue. That makes sense. So yeah, these numbers. I'm not gonna go through this math. But like, if you're making your earnings are this and your revenue is this, then your profit margin is 9.3%. So that makes sense. What is coverage ratio? Another measure to understand EBITDA value. Think of it as a solvency ratio that measures the ability of a business to pay off its liabilities associated. Whoa, I think I need to read through the sentence one more time to fully understand it. Think of it as a solvency ratio. Not entirely sure what solvency means. What does solvency mean? Solvency ratio. Measures the extent to which assets cover commitments for future payments. Assets cover commitments for future payments. The liabilities. So it is the ratio of how much your assets cover your liability, is what it sounds like. That measures the ability of a business to pay off its liabilities. That makes sense. Solvency ratio that measures the ability of the business to pay off its liabilities associated with leases and debts using EBITDA. Oh, so I guess this is given a company's leases and debts, basically how much money they owe. Then we can find out, what is their coverage ratio? How much of these debts is covered by the earnings that they are bringing in? And derive the EBITDA coverage ratio by dividing the sum of lease payments and EBITDA. Probably not even saying this right. Probably not how you're supposed to say it. EBITDA? How the fuck are you even supposed to pronounce this? This is an acronym. Give me a break. by the sum of principal and interest, debts, payments. Formula calculated looks like this. Coverage ratio is EBITDA plus lease payments. Why do you add the lease payments on both sides? Interest payments, principal payments. Why do you add it on both sides? That doesn't make sense. When the resulting value is greater than 1, it indicates that the company is in a strong position to pay off its liabilities, debts, and other obligations. As a result, it may be an attractive option for investors and potential buyers. Hey, I don't quite understand these calculations. I would have expected it to simply be EBITDA over these things, but no, it's EBITDA plus lease payments. I don't quite understand that. Because it's not lease payments paid to the company. No, it's what the company's paying, I think. But yeah, this is apparently another good calculation that you can use if you want to figure out to buy something. Oh, apparently it's EBITDA and then adjusted EBITDA. So what is this? Distinctions are minor, but they are important to understand. Adjusted, in essence, normalizes this metric depending on a company's revenue and expenses. Isn't that what EBITDA is to begin with? Normalization? These can differ significantly among businesses, making it difficult for analysts and buyers to assess whether one is more enticing than the other by standardizing cash flows and income. Removing any anomalies such as owner bonuses, redundant assets. I don't know what redundant assets are. Rent paid above market value. I mean, how do you determine market value? I would argue market value is by definition what you're paying. Enables people to analyze multiple enterprises at once. Accountants can use any of the basic EBITDA formulas discussed above to calculate adjusted EBITDA. Common list of EBITDA adjustment. Non-operating income, non-cash expenses, unrealized loss or gain, single-time loss or gain, donations and goodwill. Okay, if I said before that I agree with Warren Buffett that EBITDA is kind of bullshit and these are things that I would want to know, adjusted EBITDA is even more bullshit because these are definitely things that I would want to know. Are you kidding me? Why even with this? Holy shit, all of this is just a pile of stupid. Oh, why is it important to calculate EBITDA? I would argue it's not, but let's see. Calculation and evaluation is important. You know, the more I read about this... I'm sorry, I gotta go on another tangent. The more I read about this, the more I feel like EBITDA is bullshit. All the things that you exclude from this number are things that I feel like an investor not just wants to know, but should know. Yeah, it's deep. Calculating enterprise value is these numbers. Okay, you know what? I think I have had enough of EBITDA for one evening. I think we get a fairly good idea of what it is, why it exists. I don't necessarily agree with it, as we can see, but it is apparently a fairly common industry standard. So I think that's all. That's all we got here. Oh, one last note I did want to make is that I didn't want to bore you at the start of the video with this, but I had initially planned on making this a weekly series. However, if I do that, I am quickly going to run out of topics. So I will probably make it, I don't know, bi-weekly, perhaps. And no, that does not mean twice a week. That means once every 2 weeks, but we'll see. Depending on, I got one or two other topics I have written down for future episodes, and then after that, I am kind of at a loss. So, we'll see how that shapes up. Thank you for watching, and I will see you next time, or the next one, or... I don't know, I haven't figured out the sign-off yet, give me a break.